Welcome back to VW Exchange, episode 18, coming back to you live from Brown University. So stoked to be back here.
Super excited. We're in the podcast studio here in the Rock Library. It's good to be back on campus.
Yeah, a little better than Zoom, so we're enjoying it so far.
Yeah. Again, another fun bunch of stories. We'll kind of give you a little rundown of what's been happening in the markets the last few weeks. We have a slight pullback going on. Stocks are up today as of Wednesday the 3rd, but for the most part, a little bit of a pullback. This is due to concerns over Fed independence. We'll jump into more later. Concerns about inflation. And September is typically the worst month for equities. Maybe that's playing into it, but that's kind of what's going on right now.
Right, and maybe some profit taking after the summer is part of this too. But I think people are also seeing that, and we kind of touched on a little bit ago, and then this is maybe just showing like how fast data changes, that like when we talked about the multiples versus like the .com versus now, all of a sudden I'm seeing stories that, like now the multiples are bigger than they were during the .com era. So that's something that I think people are also just monitoring in aggregate, and they're like, certain data points out there. Like I think this story mentioned the 5% mark in the 30-year treasury being something that would tick off algorithmic traders or just tick off market sentiment in general. So I think that, those things, like the fundamentals part of this too, is just, maybe healthy correction. I don't know. How do you see it?
Probably a healthy correction. I wouldn't doubt that at all. It's natural. It's how it's going to go. It's a long climb. But in other news, just a couple of stories. Alphabet jumped 9%. Big win. I know you're a believer in them. After Google avoided most like the harsh antitrust penalties in the case against them recently, so they're allowed to keep Chrome browser and its partnership with Apple. Right,
and I didn't think about this at all. Like when I jumped into the stock, so I've kind of got some dumb luck here. But I thought it was interesting too, at least like with the CNBC reporting that I saw on it this morning, was that this was in large part due to ChatGPT and like how fast those market dynamics like kind of showed the court and showed the legislators that, there isn't such a bottleneck around that you have to use Google, or there isn't such a moat around Google that ChatGPT is coming in and taking a lot of search. I can like say in my own experience that I'm using ChatGPT more and more for search, other AI tools. I know Google has their own AI, but so search is certainly not, doesn't seem like it's always going to be Google. I think that's playing out. Which is funnily enough good for the stock, I guess, right now.
Right, it's interesting. Not what you'd expect, but Google's winning, finding ways to get it done. Another little story. Recently, Lisa Cook was officially fired by the Trump administration. It's still undergoing some lawsuits and things like that, but for the time being, that for investors looking at the U.S., it kind of raises eyebrows and concerns about Fed independence and if this is where you want to invest money in the long term.
Right, and that's that goes into the inflation piece now, that and we've kind of talked about this before here about like short-term versus long-term consequences, and that lowering the Fed's independence is not a bad strategy in the short term, that, rates go lower, and, as we'll talk about later, like maybe that means that small businesses can do better on their short-term financing. But when you think about the long term, and this is what this guy like has a quote, Matt Maley, about if inflation is allowed to rise again, the market will push longer-term rates higher no matter what the Fed does with short-term interest rates. And I think that's largely true. If the Fed's cutting rates now, then you'll have inflation, and then there's even less trust that the Fed's going to be able to control inflation in the future. That'll make yields go higher, and as those expectations fall apart too, it's not even just the Fed cutting rate, but even the future expectations that's going to be reinforce those higher yields. So pros and cons. But I think that I'm always a big believer in thinking long term, especially with a country that's very, very old.
Yeah, I think that's fundamentals of it. As you were saying, 30-year, 10-year treasuries will just spike. Yields will be spiked. It's going to be expensive to take out debt, and investors are going to look elsewhere. So we'll see how it goes. We'll see how aggressively rates really are cut and things to come. But maybe we could jump into this first story here. If you kind of want to open it up, what's going on with junk bonds right now?
Right. So junk bonds you can think of as non-investment grade debt. So these are either highly levered businesses or smaller businesses or just unproven businesses that can't get the credit rating that some of the bigger companies that we see get. And I thought this story was interesting, kind of plays along with the last story about we see that these junk bond yields are going down. We see that more junk bond debt is being able to be sold, that there's more and more demand out there for this kind of debt. And that also goes along with what we see in the private credit space more generally, that it's become a really hot part of the market, and people want a piece of that. And there's a lot of institutional capital flowing in that direction that's looking for a place to go. So that automatically is going to make it more accessible to these businesses. And it also sounds like that they're banking on a rate cut, if you've seen that part of the story. So if you have any kind of thoughts on if these investors are right, if this is too much risk, any of your thoughts.
Yeah, I mean, everyone seems to be really betting on this rate cut, and that's where this demand is kind of being fueled from. We can see even in just the last few months, junk bond yields went from close to 8.5% down to around 6.5%, 7%. So this is really being fueled by rate cut expectations and institutional investors feeling more confident that these companies that aren't investment grade are going to be able to pay back their debt obligations and looking to snag a higher return with it. So I don't know if I have any opinions on it. I think it's maybe a little bit risky throwing all your eggs into the basket that a rate cut is going to be that's kind of your catalyst and that's kind of your investment decision. But something else that this Wall Street Journal article was highlighting was just that there are a lot of tariff pressures right now and inflation concerns, as we were discussing. So it is risky. And to answer your question a little bit better, I would say it's a little bit too risky, just as you're diving into some of these tariff concerns. I was reading about J.M. Smucker, which makes Folgers and Jif peanut butter. They're going to increase their prices. There's a 50% tariff on Brazil, and that's where a lot of coffee comes from. Walmart, Target, Best Buy already instated some tariff-related price increases. Hormel Foods, Ace Hardware said they were going to raise prices. So, I mean, this isn't where the junk bond, these aren't junk bond companies.
Sure.
But it just goes to show that if these big investment grade players are facing troubles, then I would imagine some of these smaller companies are less proven are facing difficulties as well.
Right. And I think that a big part of this too is, how that experiment goes. Like when these guys raise prices at Walmart or you're paying more for your peanut butter, if consumers keep paying it and they're still buying the same quantity, then it doesn't really matter if you're the company that's taking out these loans. But watching how that consumer demand keeps up, and if it keeps up, that's going to be important. And I do think I don't necessarily know what these like junk bonds benchmark themselves against, but if they're just benchmarking themselves against short-term rates, I'd be super confident that rates are going to be a lot lower for at least for short-term rates, and like SOFR will be a lot lower if we look 2 years ahead when Trump has the Fed chair that he selects, who is almost 100% going to be dovish, right? We have a board of governors who's maybe being shaken up, and that's also going to put downward pressure on short-term rates if he's able to just put more people in there to cut rates. So it may look like a bad bet now if treasuries are at 4 and whatever these yields were at 6.5, but if treasuries fall down to 2.5 and are 6.5, then it looks a lot better. So I think these guys are right. That's just my opinion, but I think it also is just indicative of sad things to come in terms of the whole picture. But we're TBD.
Yeah, TBD. And for now, if tariffs are just a one-time price increase, then you can hope that inflation doesn't go too crazy in the short run. But if rates are capped at 2%, that lower figure that you were talking about, and inflation really starts to creep up and adjustments aren't made because there's a lack of Fed independence, then that's where we can run into some trouble. But for the short term, yeah, you might be right.
Anyway, let's see what we got next. I thought this story was interesting. Being at a university that was fortunate to be featured somewhere in this article, it talked about private equity holdings, and I think that this is something that we've touched on before, but that endowments are fundamentally taking a different look at how much of their portfolio they want to have in private equity. And there was a strategy by this guy David Swenson at Yale, who wrote this book called Pioneering Portfolio Management, that really showed the benefit of having this illiquidity premium that you get in private assets, and the ability to generate excess returns until the music stopped, and it seems like that's been harder for these guys to do. Yeah, I'll just pass it to you on any kind of thoughts about this trend. Is it a trend, or is this just kind of a blip on an otherwise successful portfolio allocation?
Yeah, I mean, we could talk about private equity every single week. They'll just keep coming up. But basically, big picture here is that these higher rates for longer have been really impacting these private equity firms. They have been able to sell their companies at the numbers that they're looking for, and have been able to cash out, really, and they're holding on to investments for a longer period of time. And this is kind of a bigger picture issue, just trying to find exit opportunities for these companies, and it's been a struggle, and we've talked about it before. It keeps coming up with the endowments, just the illiquidity, and when we're talking about loss of funding. So, and it's just questions arise about where it's going to go in the future. It was kind of cool to look at the a graph of the allocation of every asset by school. Yale led the way with 47% of its endowment invested in private equity. Brown was a close second at about 44%. So we're going to see where that goes in the future. And another part of it was just...
I should note, too, that Brown's return looks a lot better than Yale's on the graph that they had below, too. So shout out the Bears.
Yes, sir. Columbia didn't look too hot.
Nope.
They're struggling.
And I thought that this was kind of like a good opportunity, too, just to like think fundamentally about the difference between investing in the two asset classes and like what you get in private assets or what you get in public assets that you don't get elsewhere. And I think it's interesting because when you buy like some of these smaller companies or even bigger companies, but you have like all the keys to the car, and you can play with the engine, you can play with who management is and what all the processes are going to be, that you're able to just put you're able to put a lot more pressure on them to succeed, because oftentimes, and this is one of the reasons for activist investing, but it's hard to get underperforming management outside of their seat. It's hard to get their compensation to change and to get all the shareholders on board. But if you're one of these private equity guys, you can slash their salary the next day. So I think that's something that I think is interesting, and also that they're able to structure more creatively, and they can also think more long term. I put this example of a QTS, a data center REIT, that's just been able to reinvest because it's owned by Blackstone, and didn't have to meet like any sort of quarterly earnings pressure. It can just keep pumping that money back into its business without giving any of it back to shareholders, issuing any dividends. So I think that's something that is interesting. But I think you're right. We're seeing the leverage side of it fall apart, and that's been something that's hard. And you also don't get what you can get in the public markets, which is investing in ETFs and spreading out your eggs into different baskets, because you're buying whole companies really, or buying stakes. But still, it's harder to diversify. And it's also hard to know what your stuff's worth, which I think is what is really hurting a lot of these guys, is that they're going to sell and they're not really sure how to mark it up or what a proper valuation should be. Whereas you can check your portfolio on your phone every day. So I thought that was something that was interesting too.
Right. Yeah. When you talked about diversification, something else to note is that equities and private equity typically move in the same direction. So when you're thinking about diversifying your portfolio and surviving economic downturns, it might be better to just invest in equities and have that, and then have a section where you're invested in hedge funds and cash and bonds, just to spread, so you don't spread yourself too thin.
Right. No, that makes a lot of sense to me too. And I also just want to touch on quick is we're going to come to this wealth gap theme a little bit, I hope, in the Ray Dalio thing. And it's something that I'm more increasingly aware of, especially because of this podcast and some of the other stuff that we've seen. But why are some of these PE firms not doing as well is, I think, in some respect, has to be because the underlying businesses rely on this middle class, lower class consumption that are buying recurring revenue businesses, industrials businesses, consumer businesses, where they feel confident in the cash flow stream, so they can get a lot of leverage on it. But that also means that people in the lower middle class have to get richer and buy this stuff. There has to be demand at the bottom. And right now, there's so much demand at the top. And I think that's also driving the other side of the problem, is there's so much of a supply of people who can raise private equity funds and buy businesses that aren't growing. So I think that's another problem too, in thinking about this wealth gap situation and all the different things that it can touch.
Right. You bring up a good point. And just on the topic of that, I was just reading about Walmart, and they've been doing really well because a lot of middle and lower income individuals have been choosing to shop with them because of their price points, and everything's expensive these days, and the bigger companies might just get bigger because all of the lower middle income will just flock to whatever's cheapest, and that will of course hurt private equity, as their
right.
Their portfolio consists of a lot more companies than just one big guy. So another thing to kind of consider.
Yeah. And do you see that as a risk? Because one thing that we see more and more is all these antitrust litigations, and we talked about the Google thing earlier. Is that a risk to you, that Walmart gets so big because their prices are so cheap that, I don't know, someday down the line when they have 99% market share, they can say, all right, prices are 2x what they were? Is that a real risk in your mind, or is that kind of a hypothetical that doesn't make sense?
I don't know. I mean, that's a great question. I think it really could be a risk right now, and the trajectory that we're going down, and we've looked at the data, income growth is nowhere near sustained, kept pace with stock growth and GDP and things like that. So it is concerning, and I don't know if we'll ever get to that point, but it doesn't look great. And maybe while we're on the topic of, wealth inequality, it's good to kind of jump to this Ray Dalio talk. Basically, his whole thesis was that as the social wealth gap widens, people are turning to more extreme sides of the political compass, whether that's right or left wing, more drastic solutions. And he was even making comparisons to what was happening in the 1930s and 40s after the Great Depression, and there was real wealth inequality around the world. So I'll let you jump in, but I thought that was a good moment to switch to this.
No, that was a great segue. And yeah, so I mean, this Dalio story, we saw it come out in the Financial Times, and it really starts from our political moment, which is like this wealth gap situation. And Ray Dalio's broad claim is, and I don't want to oversimplify it, but that because we have that kind of wealth gap, we have more extreme political movements coming into place, that we have populism on the right, which I think Trump would more align himself with. And then we also have kind of similar things on the left with, more anarchists or more just pessimistic, people coming to power who aren't necessarily solution oriented or come across the aisle kind of thinkers. And I think that's led to, according to Dalio, the ability for the sort of autocracy that we see with Trump to take place. And what does he mean by autocracy? He means other things that we've talked about. We've talked about the Intel Trump story about the government coming into the economy. We've talked about Lisa Cook at the Fed that, and you can argue taking control of the Fed or not, but at least, putting his hands on the Fed very publicly. And with tariffs as well, that's another way that he's exerting his force in the economy, and taking the reins, so to speak. And I'm not sure exactly how he loops in this problem, the debt crisis, but it certainly doesn't seem like it's going to help anybody get to a solution to the debt crisis, of that being something that will really require people to come across the aisle and make concessions on their various political ideals. So that's kind of my broad overview, and he also gets more into the mechanics. I don't know if you want to touch on there of what this means for the dollar or rates or national debt, wherever you want to take it.
Yeah, so I mean, just one more thing I thought was a interesting statistic to mention. I believe the top 1% of the U.S. holds 35 to 40% of all the wealth. I don't know if we've ever actually said that number, but that is pretty intense.
Nuts.
And yeah, you wonder how that's going to get to. And I think when he was talking about debt, I think a lot of it was just talking about kind of the almost like lack of concern over it. We know Big Beautiful Bill supposed to add $3 trillion to the deficit in the next 3 years, and just spending that is just nowhere near sustainable and nowhere near matching the revenue. He noted that Washington's spending about $7 trillion while raising only $5 trillion in revenue. So it's just, I think that was part of it. But basically what he was saying about treasuries and the dollar falling is just that when you see an unstable economy, and yields are going to spike, investors are going to pull their money elsewhere. They're going to pull it in safer assets, commodities like gold, and the dollar is going to really lose its value. And he kind of went into the weeds about like a doomsday sort of scenario where there's almost like a bank run and everyone tries to pull their money out of the U.S. as the dollar really falls, and foreign investors lose a lot of money really quickly. So that's just kind of what he was doing. Maybe you can jump in and fill in some of the gaps, but
no, I mean, his whole theory is very complex. So I think one day, when we keep bringing this guy up, we'll get the whole thing. But I think that this story about the dollar and the fact that we have this kind of autocracy in place that makes it really hard to deal with this debt problem that he keeps pointing out. He thinks it leads us to have two situations, which is one, the Fed lets these long-term rates rise, which is what we're seeing. We're seeing the yield curve go up because people don't want to buy these longer dated treasuries. They want to buy gold instead. We keep seeing gold at all-time highs. We could make that a story every week if we wanted to. And that would mean the U.S. pays higher and higher interest rates. And at some point, you hope that either we cut spending or I don't know, maybe the U.S. defaults. We don't know where that ends up. But anyway, people aren't going to want to buy treasuries in that situation. So the dollar has to fall because people don't want to buy U.S. assets. Or the Fed says, okay, we're going to come in and try and save the world and buy all these long-dated treasuries that nobody else wants to keep everybody's mortgage rate down. But that's going to make inflation go off the hook because you're increasing the money supply. It's hard to point down when people say printing money what that actually looks like, but that is the closest thing that we have to that. And what that would look like would be inflation goes off the hook. All of a sudden, all these loans that JP Morgan and Goldman Sachs and Morgan Stanley are making, auto loans, mortgages, whatever it might be, all these basic financial products, corporate loans that everybody needs to work, all these banks are going to go under if inflation goes off the chain like that, and all of a sudden the book value of all these loans crashes. So that would be a problem. That would be a problem. And I'm not sure if I have any like super hopeful solution right now. We'll keep brainstorming on that. But it is just amazing to me that we start from this wealth gap problem that seems almost something that's just political and something that we talk about is not really impacting how the stock market's going to go or how the bond market's going to go when we get into like this esoteric stuff about the dollar and FX rates. But it's all connected. And if that is the root cause of all of this, which after reading this story, I like the theory. At least it all fits together nicely in my head. But that is going to be a problem. So I think that the political and economic are super connected, and I think one kind of can show the path to at least healing the other potentially.
Really well said. I love that. We should probably call this the Doomsday Podcast. Like we are.
We can't be so cynical yet.
So cynical. Ray Dalio was saying in the next 3-ish years or so, he expects there to be some real debt troubles. What do you think that we can do in the next few years to maybe neutralize this? Or
it's tricky. I think like we've talked about at the tariff thing as a possible solution. And I think that maybe we should have talked about this earlier, but that was struck down by an appellate court and it's going to be brought to the Supreme Court. So we'll have to watch how it happens with that. But that is a revenue stream to potentially get out of this. But I think that it's going to have to be more than that. And I think it ultimately is going to have to be something that everybody agrees on, because one of the problems with tariffs is that we don't really have Congress's approval for it. We don't have the Senate's approval for it. So I think that it's not something that's going to stick around, I don't think, post-Trump, at least in its current form. So I'm not really sure. I don't know. Do you have any loose thoughts on that?
I don't know. I'm almost going to push back on the tariff talk. I think tariffs might stay, to be honest. I think if this is truly a one-time tariff increase and a one-time price increase, and we talked about last episode, it's progress on the debt or just reducing that deficit ever so much so we don't spiral. This might just be the new norm, something that stays in place. But to answer your real question, I think it's going to come down more to cutting spending. But again, that's just not really very realistic at the moment. I don't know if there is a realistic solution that everyone's going to come to terms with, and it might take, unfortunately, a disaster situation to actually get everyone on the same page.
Maybe. And I do actually really like your point about tariffs too. I think that once a revenue stream's in place, I think having people turn away from that is going to be tricky. But anyway, let me just pivoting too quick. I don't want to spend too much time here, but I thought that this was just an interesting theoretical piece that came out about corporate governance and really what it means that the biggest shareholder in almost every company is either Vanguard, BlackRock, or State Street, and what that means for just normal investors who are hoping that their best interests are being looked out for in M&A, in different management decisions. And this study found, and I thought this was an interesting stat, a 2022 study of around 2,000 mergers found large institutions often voted for deals that hurt one company but boosted overall portfolio returns. So I thought that was interesting because, I mean, it makes sense that Vanguard's the biggest shareholder on one side, Vanguard's the biggest shareholder on the other side. They own almost 20% of every major index that you can think of. So they're in all these companies, and they might just approve stuff that you or me, as a shareholder of just one company who are loyal to that company and believe in their management, that could be value destructive to that company, but overall benefit them. So I'm not really sure how we combat that and how we should think about that, because obviously these guys do a lot of good too. So yeah, just wanted to pass it to you there on if you have any thoughts.
It seems like it seems like the overarching topic, like kind of what we've been talking about, companies getting too big and the big players stepping up. We talk about the Mag 7 every single week. This almost seems like the same sort of ordeal, helping out your biggest players and collecting some fees and voting for what's going to help, the big three, as we were talking about. Maybe that's part of it. But a solution, I don't know. That's above what I know at the moment. Maybe you think about regulation in this space and ensuring that shareholders are putting the company at hand, putting their best interests on the forefront. But, I don't know.
I think that, like, with the good, at least I want to convince myself that the good that, like, Vanguard and State Street do in terms of, like, letting us invest in their funds and having a bunch of people in there is outweighing the possible damage that might come out of some of these M&A deals. But regardless, I thought something that was worth bringing up, and also worth bringing up, like, the role of the activist investor in all this, because we've talked about private equity and, like, that being able to give you all the keys, but being able to do it in the public market and doing stuff like Carl Icahn, or doing stuff like Elliott Management, where you come in, take a stake, and raise hell about how the management's overcompensated and not doing the right things with the shareholders' money. I think that we might see that more and more, especially if we get to the point where Vanguard and State Street are deemed as non-voting stockholders. If the courts decide to do that, then all of a sudden these guys have a lot of power. So that could be interesting too, and also something that might perpetuate some sort of wealth inequality that we have. You or me, it's going to be hard for Elliott Management to take our $1,000 contribution, but they will take $1 million contribution probably. So that's another thing that I don't know, worth keeping your eye on and interesting.
Right. I like that idea. I'm sure that there's plenty of risks with that, but that is kind of free market economy and big player coming in and saying, we want this stock to win. We're not going to let you guys destroy this company with this merger. So I think that could be a great solution.
Right. And to close out, I think we have a real estate story. I think you put this one on, so I'll let you take the reins.
Yeah, so a couple of things that we're seeing. This was from BizNow. Basically, for the fifth straight month, the percentage of properties taken off the market before being sold increased. So in July, 27% as many property owners opted to wait for market conditions to improve. So sort of in the real estate market, what we're seeing here is sellers are kind of waiting a little bit longer. Maybe they're waiting for that rate cut. Kind of want to get the full bang for their buck on this value and for these properties. So you're seeing a little bit of stagnation here, but I think it's optimism at the same time because you are banking on those prices eventually going up, and there's hope there. So while I might not be seeing the activity right now, I do think it's to come.
Right. And I think that people are probably waiting for the market to price in all those rate cuts or all those prospective rate cuts so they can say, like, we're not going to sell our property at the cap rate that you'd assume with no rate cuts. We want to sell out, 7 rate cuts later. So I think that is probably what people are waiting for. So I'm sure that there is like all this pent up transaction activity waiting. And they also said that, I think this came from Avis and Young, shout out to James, our former intern, that the total number of transactions are up 25% in terms of the total nominal value of those deals. So that's certainly a promising sign too.
Yeah, valuations are going up. Maybe it even means that just big deals are happening right now. Maybe smaller deals are waiting for those rate cuts. But overall, it is looking like there's a good bit of optimism here. And as you were saying before, just the indication that there are going to be a lot of future rate cuts, not just one on the way, is also very promising.
Yeah. We do a good job always finding a way to end on a high note on these. So maybe that's a good place to wrap it up. But yeah, glad we were able to covered stocks, covered exchange rates, covered bonds. So this was a full episode.
This is a fun one. Glad to be back, and we'll keep bringing you guys content weekly.
Absolutely. Thank you all.